because the taxes, again, don't go away. They're following you as you go through, even if you do multiple exchanges. On the other hand, it can be indefinite. You can exchange and exchange and exchange. And as long as you don't sell, as long as you continue to hold for investment, or if it's associated with your business, you just keep going.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, our sponsor for the show today is Pine Financial Group, the leader in hard money lending in Colorado and Minnesota, and they were recently approved to offer their investment publicly. This investment offer is only for investors in Colorado and Minnesota and is only made through their investment prospectus. Get your copy today. Simply visit www.pineinvestments.com and click to get started. Look, there's a reason why some of the wealthiest people in history invest in loans backed by real estate. Learn more about the risks and returns at www.pineinvestments.com. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, I'm excited to have another fantastic guest. We've got Joe Vesey with First American Exchange. Joe, how are you doing today?
Great. Glad to be here. Thanks, Todd.
Well, thanks for joining me. So, Joe, I'm going to let you kind of give a background, but you are with First American Exchange. You're specializing in 1031 exchanges with your company. So why don't you give our listeners a little bit about your background, maybe life prior to that, and
Sure.
then what you guys focus on with your company.
Yeah, for sure. Thanks. So I've been in sales for a long time. I spent about 14 years in the employee benefits business, doing benefits you get at work, anything but medical. So life, disability, dental, all those things you get at work through insurance brokers. In 2016, I made a change and I ended up with a large commercial title company in town here for about a year and a half, again, in the sales role. And then I was approached by First American Exchange to come over and handle their 1031 exchange sales development area for the Midwest region, and I've been there since spring of 2018. So it's been a really positive move for me, and glad to be there.
So give our listeners kind of like maybe like a 101 on the 1031 exchange. Why would they want to consider first of all, what is it even? And then why they would want to consider it.
Yeah, in exchange, I mean, there's a few reasons why people are considering 1031 exchanges, but the biggest one is they're able to defer taxes. So again, an exchange allows people to exchange real estate for other like-kind real estate and defer taxes. And when we say taxes, we mean state capital gains, federal capital gains, and then as well as depreciation recapture tax. And I think that's one that isn't really at the top of people's radar sometimes, the depreciation recapture. I have some discussions with folks that say, well, I think it's just 15% federal and I might just pay the tax.
Yeah.
And maybe that's the best solution sometimes, but I think our role or my role is to try and help them get information and then make a decision based on all of the information out there. So that exchange allows them to defer those taxes if they reinvest the proceeds into another property for investment or held with their business. So it's not for personal residences. It's not for house flippers. Generally, it's not a good fit that way, but held for investment or associated with their trade or business.
Yeah. And I think that's really important. But, a lot of people think, I'm going to pay the long-term capital gains, it's 15%, whatever, it's 18%. But, recently I looked at selling a property and I was going to pay about just over 40% of the profit was going to go towards the government paying, state income tax. Cause you don't get to there's no long-term, at least in Minnesota, there's no long-term capital gains, treatment. It's ordinary income.
Right.
At least in my case it was. And then you have to pay the federal government, and then you have to pay, like you said, the depreciation recapture. And it all added up, and I'm going, man, I'm going to give away almost 50% of my profit on this property. I ultimately decided just to keep the property. But the other option would be, of course, to do the 1031 exchange where you can then kind of kick the can down the road, right? Because you're not a 1031 exchange. You're not erasing tax liabilities. Is that right?
Correct. Yeah, the taxes don't go away, but you're deferring them. Exactly. And you're right. A lot of people do think, well, I'll pay the tax, and then they get a closer look, and that 40 number is not all that uncommon. People think, and that's a shocker to folks, right? They're thinking maybe 15, 20, and all of a sudden it comes up at 37, and now they want to learn more about these 1031s and how they might be an option for them. So we have those discussions quite regularly.
Well, you're in a good state for 1031s because Minnesota likes to tax their their income plenty high. So
they do, and most states, 41 states have capital gains tax. So the vast majority of deals are going to have not only federal but then state capital gains as well, plus the depreciation.
Okay, good to know. Now you mentioned the flips. What happens if I buy this property? Everybody always says, "Oh, you got to hold it for a year and a day." I hear that quite a bit for 1031 exchanges. First of all, is there a magic number of months, of days, of years that I should hold a property before I can consider a 1031 exchange?
There's not a magic number. Unfortunately, the IRS did not put that magic number into the 1031 code. So you're right. A lot of tax advisors say a year and a day is a reasonable amount of time to hold the property because it'll end up on 2 tax returns. Other tax advisors will tell people 2 years, even more conservatively, hold it for 2 years. But the IRS will look at 2 things. They'll look at the time held, and then they'll also look at what was your intent? Was your intent to hold it for investment, or is it part of your business, or was your intent to, buy it, fix it up, and quickly sell that property? So both those things are important when you're considering a 1031 exchange.
So I hear this a lot, and quite frankly, I think I know the answer to it. But a flipper has a property, right? They go through the renovation, they don't sell it, and it sits there, and they wait and they wait and they wait. Maybe they even put some Airbnb tenants in there. Maybe they even through the winter have a tenant in there for a couple months. But they finally sell this property. They want a 1031. Is that a good candidate for a 1031?
It's really gray area there. That's a gray area because getting back to intent, it sounds like in that scenario, their intent was really to sell it. And because they couldn't, then maybe they sort of half rented it for a while until they could sell it. So definitely something to talk with their tax advisor about, but that one's probably pushing the limit a bit on 1031 exchange, just on the rules and regulations.
Yeah, and my accountant, because I was doing a lot of flips, and my accountant specifically said, "No, don't even think about it."
Yeah, right, right. That's definitely the safe way to do it. I mean, we tell people, talk to your tax advisor. I mean, we want to do your exchange, right? That's what we do at First American Exchange. But you want to be careful. You want to play by the rules because you don't want 2 years to go by and then you get audited and now you're down the road and you spent the money and now they say, you know what, that exchange you did 2 years ago, that's not valid, and now you need all the taxes and penalties, and it can be a real problem. So you definitely want to be careful and play by the rules.
Yeah, there you go. I mean, there's a reason, because you go, oh, maybe I get caught or whatever. I can beg for forgiveness later. I hear people say that a lot, but as you said, you've already exchanged that money into something else.
Yeah.
And now you've got to come up with that tax liability, potentially some nice penalties as well, and interest that the government wants to collect from you too. So somehow you got to come up with the extra money. And if you've already spent it on a new property, well, they still want their money. They're not going to say, "Oh,
it's
okay."
really important. It's, you just have to be careful. People ask me questions, and it's funny because I do a lot of CE classes, and they'll try and convince me that they should do a 1031 exchange. And I'm telling them, hey, I want to do your exchange, but you don't have to convince me. If I'm the IRS guy or gal, that's who you have to convince. Are you comfortable having the same discussion if I'm the IRS versus telling me, no, it's really held for investment? So that's how people need to think about it, I think.
One of the things on the flipping case too is, I think you really have to look at who you are, and what you're typically doing. So if that's kind of what you do is you flip houses, you've done that transactional business, and you're not a long-term landlord, it's going to be hard to prove that
Right.
your
Yeah.
intention was to hold this long term when that's not what you do.
Yeah, I think that's true. I think they could look at your track record and say, so you've bought and renovated and sold, 15 houses, but now the 16th one you're telling us, no, this one individually was going to be held for investment. That can be that's probably a tough discussion to have.
Yeah, yeah. So okay, so 1031, we're buying that property. We decide to sell it. We're kicking the can down the road. Is there any way we can avoid taxes altogether when we finally want to sell, or do we always have to pay the tax no matter what?
Yeah, it doesn't go away. It's kind of the old 1031 joke. It's not all that funny, but there's two ways you don't have to pay the taxes. One of them is 1031 exchanges. The other one you're not going to like as much. The other way is to leave the property or leave the real estate to your heirs, and then they get a stepped up basis
So that means you get
when
to
they
die.
inherit the property. But you're not around, right? That's not you don't get to see the joy on their face when they inherit those properties at a stepped up basis. But that would really be the only other way to do it, because the taxes again don't go away. They're following you as you go through. Even if you do multiple exchanges. On the other hand, it can be indefinite. You can exchange and exchange and exchange, and as long as you don't sell, as long as you continue to hold for investment, or if it's associated with your business, you just keep going.
Yeah. So it's either you keep going, well, and in that case, it would be till you die. Right.
Right.
Well, once you finally pass, then no longer is it taxed. I think one of the biggest advantages, in my opinion, and maybe you can add more to it, is that you get to utilize that entire profit to then leverage up to a larger property, and then utilize that entire profit to then leverage up to another property. And when you think about the power of real estate and the leveraging and all that, you've got just a bigger kind of egg to work with, versus if you pay the taxes, if you go, well, I got to pay the taxes anyway, why don't I just pay it now? We know exactly what we're paying now. Maybe down in the future we're getting taxed at 50%,
Right.
but we know right now that if we can work with $100,000, our $100,000 down payment is, maybe a $500,000 building, versus if we got to pay the taxes now we can maybe only buy a $250,000 or $300,000 building. So I
Yeah, I
think
mean that's one of the reasons we talk about that often, is just that increased purchasing power. If you're not sending 25 or 30, or in your case 40% of your gain to the government, you have more money. So when you are looking to purchase your replacement property, you can buy a larger property or a bigger property, a nicer property. So yeah, it's definitely leveraging that money, and you put it to use versus sending it away to the government.
any other kind of advantages or reasons why you would consider doing it?
Um, I think the one that sneaks up on people is the depreciation recapture. I think where
Mhm.
people get in their head is I know I'm aware of capital gains. I'm not quite sure how my state does it, but more of federal. But then when they get the real numbers, if they've owned a property, for 5 or 10 or
Yeah.
even 15 years, that number can be significant. And that's when people look at it and say, well, wow, I didn't know it was going to be like this. So then
Mhm.
they start looking a little more closely. I would say that would be one of the biggest advantages.
Yeah. Yeah. Especially, can think about if you've depreciated the asset completely down. I mean, that could be some massive gains especially if you bought it right and you're selling it right. I mean,
Yeah. Yep.
man,
Exactly.
you could be paying a pretty hefty bill there. So let's talk about the kind of the inner workings then of the 1031 exchanges, because it's you're dealing with the government,
Yes.
or government regulations. So it's probably not super cut and dry.
Yeah. There's a lot of gray area in 1031 exchanges. some of the rules and regulations are pretty fixed in black and white, but there's a lot of gray area, and you definitely should be consulting with your tax advisor or legal advisor as you go through this process. Some of the basic rules: you have to exchange for like kind property. Like kind is basically real estate for real estate. Some people think, well, if I sell a duplex, I have to buy a duplex, and that's not the case. You can sell a duplex and buy a strip mall, and you could sell a strip mall and buy an apartment building, or sell an apartment building and buy office. That all works. That's considered like kind. So that's one of the main rules.
Income producing real estate.
Yeah, income producing real estate. You can buy land as well.
I was just going to ask you that. Okay.
There's a potential tax issue if you're moving from a depreciable asset to land which is not depreciable. Definitely want to consider that and visit with your tax advisor on that. But you can do that. That is considered like kind generally. The other rules that we get into, there's some strict timing requirements around the exchange. You have 45 days to identify your replacement property. You have 180 days total to close on your replacement property. And the important thing to know about those dates is there's no wiggle room. They're calendar days. They count them all, and they're very strict. So sometimes people, hey, can I get an extension on those somehow? Or I'm not finding something. People really need to probably be looking prior to selling what they're going to do, selling their property in the exchange, because that 45 days can go quickly and there's no extension periods. So they need, it goes fast, and they just need to be aware of those timing requirements.
So what happens if I said, hey, I'm going to do this 1031 exchange and I don't meet one of the deadlines? What happens?
You have a failed exchange. So you pay the taxes.
No penalties, just pay the taxes.
You just pay the tax, right?
Okay.
So
okay.
Yep.
And any legal or consulting fees and whatever.
Yeah, so, some people, depending on what they're doing and what people are trying to do, some people set up an exchange. I mean, exchanges generally aren't real expensive to set up, and some people set them up and sell and have the qualified intermediary hold those proceeds as they look to find, can I find that property that I'm looking for? And it is sometimes worth the flexibility to get another 45 days to find something and potentially defer a lot of taxes. And it's not the end of the world if people say, you know what, I tried and I couldn't identify anything. I couldn't really find what I was after. And in that case, they get their money back, less our fee, and they pay the taxes and move along.
So why, like, you do this business, why are you important, or somebody like you? Why is that important to have someone like you a part of this transaction? And why can't I just do, hey, I'm going to 1031 exchange it. I know I can't touch the money. Maybe I have my uncle do it, have the money or whatever, send it to a friend, or
you do have to use a qualified intermediary. Surprisingly, there's very little regulation on qualified intermediaries. A lot of people can be a qualified intermediary, but they do identify, or the government does tell us who cannot be, and it can't be a disqualified person. And they define that as any relative of the taxpayer or anyone who's acted on the taxpayer's behalf in the 2 years prior to the exchange. So generally, that means they're the taxpayer's lender, their real estate agent, their CPA, their attorney, people like that. They want a disinterested party to do this, and you do indeed have to engage with a qualified intermediary. If you hold the funds, or if you have constructive receipt of the funds at all, it's too late to do a 1031 exchange. So once in a while, we'll have someone call and say, hey, I just sold and I just closed, and this 1031 sounds great. I think this is a really good fit for what I'm trying to do. And if it's not set up prior to their closing, they're too late. So that's really one that people should remember. It seems pretty basic, but I do have people come up to me when I do classes and they ask me about, I sold and then I thought I could do it immediately after that, but you need to have your exchange set up prior to closing on your relinquished property. If you don't do that, you can't do an exchange.
So you want to make sure that the title company you're working with is well aware of what's going on, that
Yes.
you're involved, the qualified intermediary is already involved. All that's set up prior to signing on the documents saying,
Yeah, I mean, there's usually cooperation language that people put in the purchase agreement. I mean,
Mhm.
we're really there to be a resource for people to help them through this process. A lot of our discussions start with, hey, I'm not even sure if this is a good fit for a 1031 exchange, but
Mm.
I'd like to tell you what I'm trying to do. And then we can ask them some questions and, tell them to work with their tax advisor, but walk them through the guidelines and say, yeah, from what you've told me, this might be a good fit for what you're trying to do.
Hey, let's take a minute to thank our sponsor, Pine Financial Group. Look, you work hard for your money. Is your money working hard for you? Because of inflation, money sitting idle erodes your wealth. Many investors understand that real estate is a great investment, but may not want the effort or the risk that comes with owning their own property. They want to sit back and have payments hit their bank account each and every month. Stop eroding your wealth and start building it by asking your money to work for you. You should be earning profits while you sleep, an investment backed by real estate. Pine Financial Group, the leader in hard money lending in Colorado and Minnesota, was recently approved to offer their investment publicly. This investment offer is only for investors in Colorado and Minnesota and is only made through the investment prospectus. Get your copy today. Simply visit www.pineinvestments.com and click to get started. There's a reason why some of the wealthiest people in history invest in loans backed by real estate. Learn more about the risks and returns at www.pineinvestments.com. It's www.pineinvestments.com. What if I find a property I really like and I go, man, I want to buy this property. I don't have the cash, or maybe I even do have the cash. I just want to buy this property. But I'd like to then sell another property in 1031. Is there any possible way to buy a property first? Then
Yeah, there is. So
sell?
yeah, and a reverse exchange is they're getting more popular, and they're popular like in our market, like in the Twin City market. The market's hot, right? So if people find a property that they really like and they think that's what I'm after, that's really what I'm looking for, there is a way to structure an exchange where the QI, the qualified intermediary, we actually form an entity. We form an exchange accommodation title holder. It's an LLC, and we're going to go into title on that replacement property. Now we're going to go into title. It's not our money. It's the taxpayers' money. They're going to have to get a loan or make a loan to this EAT. We're gonna go into title on that, and then it works in reverse. So they have 45 days to identify what they want to sell, and then 180 days total to close on what they're selling, and then the exchange is unwound, and the taxpayer ends up with the replacement property they wanted in the first place. So there is a way to structure that. It's more complex. It costs more, but it can still be a really effective solution depending upon what they're trying to do. We do see them when people are saying, "Boy, that 45 days is so short. It goes so quickly." You don't have to worry about that if you do a reverse exchange, because you're out there looking, you find something, and you can move on it. On the other hand, you want to be pretty confident that you can sell what you're going to sell. Otherwise, you're going to end up with both of them at day 181.
Well, yeah, and for the money you think you can sell it for, it's probably
Right.
more important because you can sell anything just for how
Right.
much.
Right. Yeah, and
So,
that's probably one of the challenges in the reverse is you got to come up with the money, right?
yeah,
Because the money that you have may be tied up in the property that you're going to sell, but you haven't sold it yet. So you're going to either need the cash, or you need to go get financing to purchase the replacement property first, and then you'll get the money later when you sell your relinquished property.
have you seen that type of transaction happen?
Oh
Have
yeah.
you been involved in that?
Oh yeah. Yeah. We do.
So,
We do probably 6 or 7 of those a month through our office. So
oh wow, okay,
they're not every transaction. They're typically on a little bit larger deals,
yeah.
because there's more requirements. The costs get up. Uh, they cost more than a standard deferred exchange. But it can still be a really good solution depending on what they're trying to do And again, it just gets down to math. What's the numbers? What are they trying to defer on taxes? And then does it make sense to spend that money to get a property they really like, and do a reverse exchange?
So if I'm going to do this reverse exchange and I identify a property, maybe $1 million, $2 million property, whatever, 5 million, whatever it is,
Mhm.
um, so because of how we're setting it up, um, are you seeing lenders involved still where they will lend, 70, whatever, 80%, whatever?
Yeah, that's a good question. That's one of the discussions we have early on is if there's a lender involved, we need to be involved and have a discussion with them early because
Yeah.
there's some non-recourse language because we're going to be on title that
Yeah.
needs to go into the loan docs. And they're essentially underwriting the taxpayer, but we're going to go on the title. So some lenders look at, the taxpayer like they're from the moon a little bit, but there's some lenders that are comfortable with it and they understand the process.
Okay.
And but that's definitely something to get your lender involved early and have those discussions so they're comfortable with what it looks like and how that process works. But yeah, there can definitely be a lender involved.
Yeah. And so then the rest of the money would come from the buyer, ultimately.
Correct. Right. Yep.
Um, what, so I got this 1031 I'm going to do, and I identify, I'm identifying my properties, but I'm really having a tough time identifying enough properties. Is there any way, how can I find these properties? Obviously we know realtors and stuff, but if I can't identify properties, is there any other solutions?
A couple potential things. One, I'll put in a plug for our platform. We have a platform called InvestEagle. If you go investeagle.com, the platform is really designed to be a matchmaker between people, investment property listings, and then our 1031 exchange clients as well. So it can be a good place to look for replacement properties. The other one that we see people investigate, and again, this is definitely one to talk with your tax advisor on, but people do go into what they call a Delaware Statutory Trust or a DST. And it's for the right situation where people, maybe they don't want to buy real estate or be actively involved in owning real estate anymore, but they don't want to pay taxes. So they're looking, that they have your question, is there another option out there? And a DST allows someone, it's like kind for 1031 exchange, but it allows them to invest in real estate passively and still defer, the state federal capital gains plus the depreciation recapture. They're a financial security. They're offered through financial advisors. We don't sell them, but I work with some people who are very well versed in those, and they can be an option for some folks, depending on what their goals are, what they're trying to do. Generally, those are for accredited investors as well. So not everyone is going to qualify to be able to do that, but it is one more option out there that's not super well known, but I think they're getting more popular.
So you might not be able to directly answer this question, but I get a lot of investors that ask me this. I do multifamily syndications. They say, "Hey, can I sell something in 1031 exchange into your multifamily syndication?" What's your answer to something like that?
Well, it depends how you, being the syndicator, how you setting up that entity, right? How are you setting it up? Usually, I mean, generally speaking, it's not a good fit, um, because one of the rules on 1031 is how you sell is how you have to buy. So if Joe Vesey sells, Joe Vesey really has to buy, and I can't buy a 2% interest in Todd Dexheimer LLC because a partnership interest is specifically excluded from being like kind. Now, if you set it up as a tenant in common, where you have 20 people investing and everyone owns an undivided interest, potentially that would be a way you could do it. Although then you have other issues as the syndicator because you
Right.
need unanimous decisions and things like that. So it can be challenging whenever people say, "Hey, I'm going to sell individually and I want to go into this development." Is there a way to do it? Yes. Is it challenging? Yeah, really, really challenging at times.
Yeah, it can be done. And I do know that, but yeah, like you said, it can be challenging. It's definitely a little more expensive to typically set them up than regular syndication would be. And obviously you want to know the limitations to it, because a tenants in common, is definitely different than your traditional syndication model setup where you just have an LLC and people are buying the shares of the LLC. There's,
Right.
as you said, for me as the lead, that creates a kind of a whole different um, set of problems, because no longer are you truly the lead on a tick.
Right. You're one of 20, really. I mean,
Yeah.
that's the challenge. So to answer the question, really, they should talk to the syndicator and say, how are you setting this up?
Yeah.
And if I'm going to 1031, is it a possibility that I take these funds and invest with you if I was selling something to go into your syndication? That would be the place to start.
Which is kind of where the DST comes in, and why some of these companies, I think, are favoring the DST over the tick, is because in the DST you can maintain control, as far as what I understand.
Well, I don't know that it would be considered as control, because you can't. I mean, and again, I'm not a DST expert, but you can't cash out. You're really a passive investor. You don't have really say in that property, but you don't have unanimous. You don't need 20 out of 20 to agree on something.
Right.
So DSTs are, the money's not liquid. You don't have a
Yeah.
lot of control, but it's a passive way. It's probably for the person who
Oh, sorry.
I
I
may not
meant
want
the
to buy real
lead.
estate.
I meant more like the lead. The sponsor team has a little more control in a DST, where they can, as
Oh,
far as I understand, make more decisions and decide kind of what's going on with the property.
yes, for sure. Absolutely.
Cool. Well, Joe, you've given a ton of good information. Anything else that people should know about 1031s?
Yeah,
Basics,
a
more in
couple
depth.
things. I think there's one big misconception that we deal with a lot, and it has to do with having a fully deferred exchange. So fully deferred meaning we want to defer state and federal capital gains, and we want to defer the depreciation recapture. And I have this discussion definitely weekly, and sometimes even more often than that. But to do that, you have to do two things. One is you have to buy at or above the level you sell at. So if you sell a real estate for $500,000, your replacement property needs to be $500,000 or above to do fully deferred. The other thing that has to happen is you have to take all the proceeds from the sale, put it into the exchange, and then reinvest those proceeds into the replacement property. And the misconception is that people think, well, I'm selling for 500,000, but my gain on this deal was 200. So I only need to invest the 200,000. And there's a lot of people that is how they understand this, and that is not correct. So that's one big misconception out there. If you sell for 500 and you want fully deferred, you have to buy at or above $500,000, and then take all the proceeds you get and reinvest it into the replacement property. That's one thing. And then the other thing, I think, is just important to do your due diligence on qualified intermediaries. There's not a lot of regulation. In fact, there's no federal regulation really on qualified intermediaries on how they invest the funds. So you want to make sure who you're dealing with. It can be a lot of money. You want to make sure people are experienced at this, that they're separating the funds out, that you open up a segregated bank account for the taxpayer with their tax ID number and their name. Because I always talk about this in the CE classes I do, but there was an episode on American Greed where the QI took the money, and it was just the worst possible scenario. So you just want to do due diligence on who you're dealing with. Make sure you're dealing with a reputable company that's going to be there and offer financial security and expertise in this field.
Awesome. Is there any regulation on if I got a loan on it? Does the loan amount need to be the same, or anything like that?
There's not regulation on the loan amount. When we talked about fully deferred, about buying at or above and then reinvesting all the proceeds into the replacement property, the third part of that is that you have to replace the value of the debt. But if you do the first two things, that third thing will take care of itself, because you'll need the money. You either need to go get a loan and bring that to closing, or you can bring cash money to close. So if you do the, buy at or above and take all the proceeds from the sale and invest it into the replacement property, that replacing debt part takes care of itself.
Gotcha.
So that some people think I have to get a loan. And you don't technically have to get a loan, but you need to have the money. It can come cash out of pocket. That still works.
Okay. What happens if, identify 3 properties and, like you said, if I sold my property for 500,000, maybe I made 200,000. Somehow I don't hit those markers, but I do buy some properties, but maybe I only bought $400,000 property. The other sale fell through.
People do trade down, and that would be considered boot. So if you sold for 500 and you ended up buying a replacement property for 400, that still can work for, you can do a partial exchange, but the taxpayer will pay taxes then on that $100,000 trade down amount. The same thing would apply. Sometimes people want to take money out of the deal. They say, I'm selling for 500, but I need to take, $40,000 cash out of the deal.
Mm-hmm.
They can certainly do that. They should do it at the closing table prior to those funds coming into the 1031 exchange. But they can take it out at the closing table, just knowing that would be considered taxable boot, and they'll be taxed on that. In that example, 40 grand they take out of the deal.
They're taxed on just the 40K. They're not taxed on the 200K of profit.
That's correct.
Okay.
Yep.
Yeah, That makes sense. Awesome. Anything else? Do you want to add?
That'll do it. I think we gave a good, some good information, enough to be dangerous, and let us know if we can help. We're there to be a resource.
Yeah. Well, so speaking of that, Joe, how can our listeners get in touch with you and kind of maybe learn more and have that conversation when the time is there?
Yeah, anytime. My cell phone is probably the best way to get me, 612-413-8073, or you can certainly shoot me an email. It's J, and my last name is V like Victor, ESEY @firstam.com.
Awesome, Joe. Appreciate it. Thanks a lot for the time and a ton of value you were able to add.
Thanks so much. Thanks, Todd.
Thanks.
Take care.
Hey, thanks for listening to the show. Couple things before we go. Again, go on to our Facebook page, Pillars of Wealth. We'd love to have you on there. Go on to iTunes, give us a rating and review, and subscribe to the show. Also, don't forget, reach out to me if you want any help with potentially growing your business, and reach out to John Stiles to help you buy or sell real estate. Thanks for listening. We appreciate it. Have a fantastic the rest of the day. And as I say, make every day a Saturday.